Hi there, this is Kritesh and welcome to TradeBrains YouTube channel. In this video, we are going to discuss what is top-down and bottom-up approach in stock investing. First of all, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. While performing the fundamental analysis of companies, two of the most common strategies to research stock that are used by the investors are top-down and bottom-up approach. In this video, you will learn what exactly is top-down and bottom-up approach, how they work, and which one may be more suitable to you. Let's start with top-down approach. Have you ever heard of any investor or analyst saying something like, "The electric vehicle industry looks particularly promising now. The industry is growing at a fast pace and I should invest in this industry." Well, here the investor is following the top-down approach to find stocks. In the top-down approach, the investors first look at the macro picture of the economy and later work down to research the individual stocks. The overall steps involved in top-down approach is to first look at the bigger picture of the world, that is which economy is doing great, then look at the general market in that economy, next find the particular sectors that may outperform, and finally research the best stock opportunity to invest within that sector. For example, let's say you studied that the European economy is growing at a very fast rate. Next, when you looked further into the European market, you found that especially the biotechnology industry is outperforming. And finally, you researched some appealing stocks in that industry to invest. This is the top-down approach for stock investing. Here you start with the big picture and ultimately move down to find the suitable investing opportunity. Top-down approach looks at the performance of the economy and sector and believes that if the industry is doing good, the chances are that the stocks in that industry will perform well too. A few of the major areas which the top-down analysts pay attention are economic growth, industry growth, GDP, monetary policy, inflation, prices of commodities, bond yields, etc. before moving into the specific industry study. The biggest advantage of top-down approach is that here there is no preconceived notion that what may work, and the selection of economy, industry and stocks are based on the real-time studies. Further, as they focuses on strong sectors, the chances of underlying companies performing well are favorable. However, one of the major flaws of top-down approach is that here you may miss out a few good bargain stocks in the eliminated studies. For example, let's say that you eliminated the automobile industry thinking that it might not perform well in the next 2-3 years. However, here you may miss out few good companies in the automobile industry which might outperform. Now let's move forward to the bottom-up approach. This approach is exact opposite to the top-down approach. Here you first start with the company research and later move up to find the other details. Bottom-up approach tries to study the fundamentals of the company regardless of the market condition, industry, or the macroeconomic factors. While performing the bottom-up approach, the investor studies how fundamentally strong the company is by focusing on its revenues, earnings, financial ratios, products, services, sales growth, management, etc. The key here is to find the potentially strong company which may outperform the industry and market in future. If the fundamental factors are good, then regardless of what the industry is doing, the bottom-up investors will pick such companies to invest. The biggest advantage of the bottom-up approach is that the investors may find the best potentially strong company which can outperform even if the economy or the industry as a whole declines. Bottom-up approach helps in picking quality stocks. On the other hand, one of the cons of bottom-up approach is that the investors may have some preconceived notion of the company, and in such condition, their investment decisions may be a little biased. Further, as these investors ignore the longer economic influence and market conditions, some investment returns may be adversely affected because of these factors. So let's conclude what we discussed in this video. Top-down and bottom-up are entirely different approaches to analyze and invest in stocks. However, both these have their own advantages and disadvantages. The top-down approach first looks at the broader economy and the macroeconomic factors and then moves to the specific industry and company within. On the other hand, the bottom-up approach starts with the company level and later moves up for the other important details. In general, the top-down approach can be a little easier for the less experienced investors as they do not have to perform the intense stock research and analysis. They can start studying the most appealing industry and find the companies within to invest. Anyways, both approaches have their own effectiveness and hence difficult to say which one is better. Moreover, it also depends on the knowledge and preference of the investor. My final advice would be better to try out both the approaches and find out which one suits you the best for your investment strategy. That's all for this video. I hope it was useful to you. If you enjoyed it, please hit the like button and subscribe to this channel for more interesting investing videos. This is Kritesh signing off.